Okay, so thanks everyone for taking some time out of your day to join us here. And we've got Ian Irvine, who was presented to us a couple of weeks ago. So we've got a follow up to that discussion around listed investment companies and trusts. So Ian, I will throw it over to you.
Great. Thank you, Rob. And thanks once again for this opportunity to talk with your advisors. We really appreciate this. And we're going to be doing some more of this at your New Zealand conference in a month or so's time. That's getting close.
Excellent.
Today, I'm going to introduce you to Emma Davidson, who's the CEO of State A Capital. And Emma and her husband, Miles, run a listed investment company. But our topic today is around active versus passive and why not all good investment ideas are in an index. And I'll leave that to Emma to talk through in a moment. What I'm going to do in terms of agenda is just come back. I'll introduce Emma a little bit more formally and then pass over to her. I'll recap on some of the discussions we had last time about the Listed Investment Companies and Trusts Association, let you know what we do and where I sit in the scheme of things. A brief recap on the sector, and I'll stress these really brief because we did a lot of this last time, but I've now got June figures updating the ones we showed last time, which were in March. Then I'll pass over to Emma. As I've mentioned, Emma and her husband work together, and she's going to recount a story about how she, in her words, lost the debate around active versus passive. A little more to come from Emma in that regard. And then your questions at the end, Rob, if you want to come back and join us for Q&A, we'll take it from there around about 25 minutes. So just a little bit about the Listed Investment Companies and Trusts Association. We as an association and our membership champion the interests of LICs and LITs. And we also represent the interests of around about 850,000 Australians who've chosen to use one of these structures to invest. They are predominantly retail investors or trustees of self-managed super funds. And it would be fair to say, in my view, they have a very strong focus on income. They're interested in the capital protection and retention, but a lot of what they invest for is income. Our members represent around about 76% of the value of the $50 billion sector. I should point out Emma is one of our directors. And our members have been supporting investors for over 100 years. We have a couple close to 100. We have one that's now 101 years. Plenty in their 70s. Then we have a newer bunch coming through around about 25. So a good cross-section of styles and asset managers across our sector. We closed almost last time with this slide. Just to reiterate, listed investment companies, listed investment trusts are actively managed. Very key to our discussion today. Like other investments, they're pooled, but the big difference between closed-end listed investment companies and listed investment trusts, unlike open-ended ETFs or managed funds, for example, with closed-end structure, the investors' tax consequences are their own. They decide when to buy and sell, when to take a capital gain or loss, rather than share it mutually. Typically, LICs and LITs have a patient approach to buying and selling assets. They don't track or are not wedded to following an index, and they can make decisions to sell into overheated markets and perhaps buy where they see value in the future. And as I mentioned a moment back, consistent stream of income is significantly important outcome for these guys as well. And they're listed on the ASX. Here's the slide to tell you that the market's size or sector size sits around about $50 billion. I mentioned last time, numbers are drifting down. A lot of that is consolidation within the sector, but we're sitting constantly around about that $51 billion mark. I think one of the aha moments for looking at, for the first time to have a look at LICs and LITs, is the range of asset classes that are available and how that's shifting over time. And these three pie charts show that. The one on the left, December 17, the large light blue area, 8 o'clock, that was Australian equities. You can see that's now coming back to 6:30 or 7 o'clock in terms of the shape of the clock. And whilst the sectors continued to grow, other areas such as global equities and fixed income, particularly through the trust structure, has shown significant growth over those periods. And the last pie chart on the right just shows you the numbers that are available in each of those sectors. So there's plenty to choose from and to achieve the diversification. Probably very poignant to today's discussion, these two charts show you the yield. So this is not the performance and of each of listed investment companies called the index. I'll come to that in a minute. On the left-hand side, the sector at large is trading at a discount. When we last spoke back, when I used the March figures, it was close to 15%. You can see how that's come back to around about 7.5. Typically, when times become a little uncertain, and there's lots of talk about interest rates coming up or down or staying or what's going on, investors tend to go back to the sure hands of a listed investment company. On the right, these are the yields. The bars show the yields that LICs and LITs are providing as a weighted average across the sector, and the orange piece on top is the benefit of franking. The grey line snaking down through there is actually the yield on the index. It's not the index performance, because we all know the index is racing ahead. And Emma will talk to this a little bit more, but there's an awful lot of growth in the index without the attendant income following through. So too, when we look at global, again, same trends since March 24 to June 24, discounts are coming back. But on the right-hand side, those two bars, against the bars, those two lines, the grey and the yellow, that's the MSCI World Index, as well as the S&P 500 in yellow. Again, these are the yields that the index are showing. And as we all know, there's a lot of activity going on with the top few stocks globally, as well as in Australia, in those indexes, and not all of them pay dividends.